This week, we bring you part 2 of our exclusive interview with financial planners Ryan Ponsford and Matt Regan on how to successfully approach and engage financial professionals and wealth advisors. Welcome back to the Industry Leader Update. Today we are continuing our conversation with wealth managers and financial planners Matt Regan, Ryan Ponsford, and also OneTrust Home Loans' Jesse Allen. Your comments made me think of our industry as a whole and then getting down to a more granular level. What can loan officers or our industry at large be doing to help attract more business and referrals from financial professionals? How can that be accomplished?
I'll take a shot at it, and then I'm sure Matt. I can see Matt and Ryan both have things to say, and Matt, don't worry, you won't rub us the wrong way. I think, listen, it's an interesting question, and one that I had to ask myself when I decided to get back into the business, which is partially why we grabbed Ryan kicking and screaming, and another financial advisor that we have on staff. I think people work with people they trust. That was my experience in 20 years of consumer banking. Anytime I wanted our commercial lenders to go bring our investment advisors out and meet the C-suite of the company they may be lending $100 million to, it was about trust. Do I trust the person? And does the math work? Am I solving a real problem for my client? And what's the impact on my business? So as I think about our industry, I think the customers and the customer dynamic and the industry and the time has changed around the industry in the 14 years that I've been around it. And I do believe we've underinvested in developing our people, the tools, the market awareness or positioning of the product and the use of housing wealth. And so how do you begin to peel that back? Well, it starts and stops with people. So first of all, do we have a sales force who truly understands they all have the passion and the commitment to customer that's needed to serve that, let's just say that triage customer, the traditional needs-based client. But do they have the mortgage banking acumen, the comfort level with working with financial advisors, the business development skill set? So have we invested in the right people who can walk into a financial advisor's practice and with credibility look them in the eye and earn that trust? So not everyone has that day one, which is okay. So what do you do about it? You bring folks on like Ryan and his team to help invest in our people, to develop and level up the skill set. So if you build trust, I think that's the biggest thing. Clearly, there's awareness, to Matt's point. And I think a lot of, again, I'll say it, the product, the consumer safeguards that went into the product post-financial crisis, in my experience talking with financial advisors or elder law attorneys or estate planners, that de-risked the product quite a bit. It's educating folks around that. And then once you have that license, now it's building trust and credibility so that folks can trust you with their client. And I think that's an investment that the industry has been making more of and should continue to make so that we earn the right to sit at the table with Matt and his team.
So for Ryan and Matt, how do you see that playing out? How can we do better in engaging the financial professional?
Well, let's take it from my side because we've got a bunch of financial advisors here. I think what Jesse's hitting on is, we are an objectively siloed industry across financial services. People do specific things, and to the extent that we can break down some of those silos and cross-train people and make them aware, I think that's the key to gaining broader acceptance. That being said, I've already seen it. I mean, you have industry leaders like Michael Kitsis on the financial planning side who have, talked about the use of, housing wealth in financial plans. That could be a game changer, right? I mean, you have thought leaders that are talking about this, that are saying, no, let's get away from that idea of the needs-based, lending, and let's talk about how to use your largest asset in retirement planning. That's going to change things.
Yeah, those all make a big difference from a loan officer perspective. I think there's really kind of, three things to this. Someone was telling me a while back around the idea of catching a fish. right? And if you want to catch a fish, how do you catch a fish? And the answer is you have to be able to think like a fish. And so there's part of this of, becoming a student of your craft. And I think, loan officers could do a way better job of understanding the financial industry better, right? How do you understand what they do, how they do it? What are their concerns? How do they serve clients? What are the things they're trying to solve? There's an element of understanding that needs to happen there. But maybe even more important, and this is not intended to bash the industry, but there's a lot of loan officers that aren't students of their own craft, right? How do we understand our own thing? Because financial professionals are taught to question things. They are taught to be the defense between everybody trying to sell their clients something and what's in their best interest. And so they're naturally going to try to understand it and find the flaws. And so they're not going to fall for a sales pitch. They will understand the mechanics. So if you can understand the core mechanics of it, they get hit on by wholesalers and people selling them stuff every day, all day. Institutions are product manufacturing companies, and they view advisors as distribution channels of their stuff. And those that are good, some do that, and that's all they do. The good ones, the ones that are planning and taking a holistic approach and serving their clients, are in the business of protecting their clients from that environment. And so it forces them to have to understand it. So loan officers need to be able to understand how their own thing works, and then the impact and implication that will have on the other parts of the plan. And then they have to be referable. At the end of the day, for an advisor to be confident, if I'm going to introduce you to this family that I've cared for years, and that is a big part of my business, and I've looked after them, and they look to me for confidence and peace of mind, I have to know that you're going to treat them with the same level of compassion and intellect that I would as an advisor. And so that comes back to Jesse's earlier point of trust. You have to have competence, do what you say, be able to connect, and put other people's interests before your own.
So speaking of understanding, Matt, what are some of the trends that you're seeing in your industry as a wealth management and financial planning that we as reverse mortgage professionals or the industry at large should be aware of?
Well, clearly, the days of the stock picking advisors, who were not involved deeply in the entire client's financial life, or were unaware of, goals and milestones and dreams and wishes, and that the squishy part of wealth management, are quickly coming to an end. Although you'd be surprised how many advisors are still out there that are simply managing money. The trend in the industry, and the only way that advisors are going to get paid going forward, is to provide a 360 view of the client's life, and to be creative, and to introduce products that actually work. I think the flip side of what Ryan just pointed out is that advisors see through products that don't add real value. And if this approach, if the use of reverse mortgages in retirement planning didn't have real advantages, we wouldn't be on this call right now. It really does work. And I think that's critically important. And I think the advisors are smart enough to see through that. So, in the industry, this movement towards holistic financial planning, as the value add service is undeniable. And I think that's one of the reasons why, products and services along this line are going to be critical going forward.
Yeah, even more so with the volatility we're seeing in the equities market. So good point. Ryan, what do you see in the future of the blending of home equity and retirement planning? What do you anticipate?
Well, I think there has to be more of it, put as simply as you can look at it. I think what's unique about this is what most people don't realize, what in designing a plan, there's some core things you're looking at. The goal in retirement is cash flow at the end of the day. First and foremost, don't run out of money, right? And when you can show somebody, hey, can we extend the longevity of cash? Can we give them, maybe improvements to their lifestyle, or at least we're not having to go back and go back to telling them to behavioral modification, stop going to the country club and Starbucks and so forth. That's never a good outcome. Get access to liquidity, because bad things could happen down the road, or opportunities could happen down the road, but you want access to liquidity. And then you want to be cognizant of what the kids get at the end. And if we run things through those four funnels, and we can show that by including housing wealth, we can improve on, in many cases, all four of those areas, then I think it becomes a thing that must be dealt with. Again, you can't unsee that. It has to be accounted for in a plan, because you're essentially accessing assets that you didn't otherwise have. One of my colleagues, Hank, and I did a little test not too long ago. We were running some math and trying to figure out, on average, if we looked at the number of clients that an advisor has, how many assets they manage, and bunch of assumptions, so it may not be exactly accurate, but we figured the average advisor has probably about 25 million in accessible equity that they could incorporate into their overall book of business of planning, right? And that doesn't mean, suck it out and go buy the Vegas exploding fund, right? But that means account for it, because you can create better outcomes. You can improve the cash flow outcome. You can create liquidity for something that happens down the road. And again, many times when you look holistically, can create better outcomes for the kids, because you're able to change your withdrawal rates. You can change, when you're pulling from taxable, non-taxable accounts, and create some efficiencies that you wouldn't otherwise have. So I think the future has to include integration. There's no great tool that integrates them effectively. We've talked to Matt and his team a lot about, integrating how this looks in software. Their stuff we've been able to work a lot of it into the GDX software platform. And what they have is a thing called a comfort zone, which is really cool, because it'll show a client, based on the goals and things they want to accomplish in life, based on what they want, are they within this band of comfort zone? And at what point do they fall out? So we've been able to work with his team and say, when we include home equity into this, what impact does that have when we stress test? What if there's a long-term care event and they fall out of the zone, and we now incorporate equity? Or had we done it earlier, what does that look like? It can put them right back into that comfort zone. So we've now been able to show that for their clients using his software. And so I think more of this integration of our two industries has to be done. Lending has never been specific for retirees. There's a lot of great lending products when you're accumulating wealth. There are very few for people that are, in that retirement, more fixed income phase of life. And so this becomes one of the unique solutions in there that needs to be adopted. And so, it's a challenge to the financial industry to be open and adopt it. It's a challenge to the reverse industry to up the game and be able to do it. So I think there's a huge amount of upside and opportunity if we can all get our acts together and start doing things together.
Matt, as one who's integrating this into your software, what do you have to add to that?
Yeah, I mean, look, this is not unprecedented, right? I mean, if you think back to the introduction of the Roth IRA, that was a product that came into the market that made, financial advisors stop and rethink how they did everything, right? I mean, you had an order of operations of how you withdrew from, your accounts that was, tried and true, and the introduction of a different type of retirement plan account, a Roth IRA, and the way that was, treated by, as far as taxes are concerned, changed the way that advisors behave. We built that into our planning software, just like every other financial planning software did. And now that order of operations is different for how you withdraw in retirement. The addition of housing wealth and the very unique advantages of using reverses in the financial planning and retirement planning, process is going to change the way that advisors behave. It's not unprecedented, and it will, if the math works, and if people much smarter than people like Ryan and Michael Kitces, prove that math works, advisors will change their behavior and do things differently.
Excellent. Before we go, Jesse, any comments you want to add before we wrap up this excellent conversation? I think we need to have more of these conversations in our industry. So again, thank you, Matt. Thank you, Ryan. We really appreciate your time. Jesse?
No, I'll wrap by building on what Matt and Ryan just said. I think when you think about scaling this, right, reverse isn't the right solution for everyone. The math is compelling for a lot of folks, but goals-based planning is unique. It's goals-based. It depends on the client. And I think the real, secret sauce here is to begin to build awareness. And then over time, how do you tech enable this client use case test so that financial advisors can figure out how to understand the impact of accessing that housing wealth, in a more autonomous way as a regular part of their practice versus needing a Hank or a Ryan sort of sitting over their shoulder. So I think there's definitely, I think, product innovation to be had as we think about the future of the integration of housing wealth and retirement income strategies. And then the industry has focused in on, how to leverage technology since the new 62 days, which was, I think, a generation mortgage product. So how do you really tech enable this conversation where it's relevant at the client level is an investment that I think the industry with different partners will have to make in order to keep really operationalizing around this in a meaningful way at the client level, because it is a different answer for every client.
Well said. Gentlemen, thank you so much for joining us here on HECM World. You brought a very needed perspective, and it's good to hear from financial professionals themselves. So thank you so much.
Thank you,
Thanks,
Shannon.
Shannon.
And that concludes this week's episode and our two-part interview series with Ryan, Matt, and Jesse. You can be part of the conversation by leaving your questions or comments below in our comments section. Also, we would ask if you would spread the word about these interviews by sharing them on your LinkedIn or Facebook profiles. Just a reminder, you can watch all HECM World episodes on our YouTube channel. Be sure to click the subscribe button if you would, and smash the like button if you enjoyed our show. And are you a fan of Audible books? If so, you're going to love catching up on your latest reverse mortgage news on our weekly podcast. That's HECM World Weekly. You can listen here on HECMWorld.com, and Apple users can listen and subscribe on iTunes. That's a wrap for this week. Thanks again for joining us, and we'll see you next Monday for more reverse mortgage news, commentary, and analysis here at HECM World.